Well, hey there, everyone. Happy Thursday, October 9th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller. Happy to be back with you today and every trading day after the close, coming to you from a kind of classic rainy fall day here in Redmond, Washington. Hope you guys are all doing well. Wherever you're tuning in from, we're broadcasting live as always on Facebook, LinkedIn, YouTube, and X. Those of you tuning in live, welcome. You are welcome to ask questions all along the way. Use the chat capability on whatever platform you're seeing this on. I can see all of those commingled here on the live stream platform. Take a question or two at the end of the episode. Any of the questions we don't get to, we will put them in the Chart This mailbag. We're planning an all mailbag episode tomorrow on Friday, October 10th. We'd love to feature one of your questions on the air. Of course, if you're watching the show later on our YouTube channel, you are welcome to ask questions anytime using the comments section. We review every question that comes in, and we'll hand select some great ones for the show tomorrow. As a reminder, I will be speaking next week at the Orlando Money Show. You can find more information at marketmisbehavior.com/money show. You can sign up for the event. I'll be giving a presentation, I believe, on Thursday morning called The 4 Pillars of Investing Success. I would encourage you to check out that presentation. Please come say hello. If you do so, it's always a pleasure to meet people that watch the show and enjoy the content. We'll also be recording some episodes of the podcast live from the exhibit hall. Also, it turns out I will actually have a booth in the exhibit hall for the first time. So I'm coming up with kind of a creative way to use that space. So we'll see what I can come up with between now and next Wednesday when I fly to Orlando. With that in mind, let's get to the markets here. Kind of an underwhelming day for the bulls. Not a huge down day, with the S&P finishing about 0.25% lower, the NASDAQ basically flat, but mid caps and small caps continuing to show quite a bit of deterioration. Now, I mean, 2025, I feel like, has been anything but a normal year. So drawing on kind of the normal tendencies at a market top feels, I don't know, feels difficult, just given the fact that this year has sort of, has shaken it up and has been very unique in a lot of ways. At the same time, we're seeing a lot of consistent kind of bubble characteristics, right? All the things that usually happen during a euphoric rise. We start to see people upgrading targets for things like the S&P and gold and other things to outrageously high levels, to where you question if that's even possible. That usually is sort of that euphoria stage that where bull markets die, as I think Sir John Templeton so beautifully put in a famous quote about investing. So is this the beginning of some sort of broader deterioration? Still to be determined, right? And I would say, as a trend follower, I'm not seeing enough to get super negative yet. But days like today certainly remind you that the market can go down at some point. Friendly reminder to make sure that we have our stop losses updated and our risk management process firmly and specifically defined. Having said that, looking at the numbers, the S&P closes at 6735 and change. That's down about 0.3%. It was down the most right after lunchtime, around 1:30 p.m. Eastern, sort of last hour rally, which is actually a pretty good sign. That's when more institutions are getting to work. Having said that, still finishing well below yesterday's close. NASDAQ composite, as I mentioned, basically flat for the day. The Dow was down a little bit more, about 0.5%. Mid caps and small caps down over 1%. You're going to see when we get to the heat map, a number of larger names are actually down a lot more than the S&P. That, I think, is even more concerning. Volatility is still not in any sort of danger zone, right? The VIX is still at a 16 handle, which basically implies low volatility, not much to be concerned about, right? I mean, a real panic, right? If there's real fear running rampant, volatility should spike pretty aggressively and in a very short period of time. And that's why you want to, remain vigilant now when things are still pretty good. But I'm not really seeing any danger signs from volatility just yet. Need to keep watching that, and we certainly will. Yields generally moving higher today. Yesterday, we saw the 30-year yield drift up to around 473. Today, a little bit above there as well. 5-year and 10-year points moving higher. The 10-year point, which is pretty crucial. That's where a lot of things are benchmarked to, around 415. Bond prices, really not much of a change. The dollar slightly higher. Dollar is one of those charts to watch, right? When you think about the current market conditions, right? What I always try to tell people is, when you have a market that's been in a sustained uptrend, which you've certainly seen with stocks, with cryptocurrencies, with commodities, particularly gold and silver, all in primary uptrends, all lights out strong, consistent upward movers. At some point, things start to change. So you look for changes of character, right? Whatever conditions we're in that are allowing all these things to rally, at some point, something's going to change. I interviewed Simon Rhee just yesterday. That interview is with my editors late last night. He's based in Singapore. He's the author of a book called The Tao of Trading, where he applies some Eastern philosophy, martial arts training to trading. And he had a successful career in the financial industry, working at institutions in sort of Asia, Australia, sort of Pacific region, and really talks about a lot of mindful practices. So we were very much kindred spirits. I asked him toward the end, like, what's that red flag chart? What's that thing that you would see? All right, if this starts to move, we need to start getting nervous. You know what he said? US dollar. So a day like today, of course, right after I interview him, where I see the dollar just starting to turn higher, thinking that's the kind of thing that could change. Gold, cryptocurrencies arguably are sort of a currency debasement play, sort of an alternative to owning, to just having cash. But if dollar starts to strengthen, all of a sudden those bets may be a little less ideal than before. So keep an eye on the dollar. We certainly will do so. Gold, by the way, not going up today, which is sort of an unusual day relative to historical or certainly recent trends. The GLD was down almost 2% today. Silver did finish higher by about 1/3%. That's using the SLV. The energy part of the commodity space, all pretty rough. And you will see when we get to the sectors. Energy, one of the worst performing sectors in the bottom three today. A lot of red on the chart of cryptocurrencies. Bitcoin did get up to around 124,000 yesterday. Today, we're pushing down to 120,000, which is where we bounced. And then in the last couple hours, we've been bouncing off of that potential area of support. So again, a lot of these charts still pretty constructive on that medium term and certainly the long-term time frame. At this point, I think you look for tactical reversals. You look for breaks of key moving averages. And that's, if you see more and more of those, that's when we start to get concerned. Not too much of a red flag just yet, but certainly top of mind for me. All right, here's what's happening sector-wise. Consumer staples, one of the more defensive sectors, one of the more lower beta, more defensive, higher yielding kind of sectors. The only one out of the 11 that was in the green today is the XLP, which is the consumer staples ETF, up about 1/3%. All the rest of the 11 S&P sectors were down. So not a great day for stocks. Technology and healthcare both down about 0.2%. So obviously, pretty much okay. But again, most things were down. On the downside, it's the MEI sectors, the cyclical sectors of materials, energy, and industrials. Those sectors were all down over 1.3%, leading the way lower and certainly dragging on the Dow. That's why the Dow and more value-oriented indexes down a lot more. Not a great day for sector breadth conditions, by the way. The way that this little widget on stock charts, which I'm a huge fan of, I love the fact that there's a kind of a breadth widget that's part of the member dashboard now. That's a more recent development from the stock charts team. I'm big thumbs up for me. And if you'll notice, we actually have the very bearish color coding, which does not happen often. I think that's if over 80% are decliners, then it starts getting shaded in the very bearish color, and that's what you're seeing here. So mid cap breadth aggressively negative, small cap breadth pretty negative. The New York Composite Index, which is a fairly broad universe, 74% decliners, 24% advancers, sort of a 3-to-1 ratio. Stocks moving down versus up. So and about the same for the S&P, about a 3-to-1 ratio. So this is distribution day, I would say, by any stretch. There were some random names that were up, and we'll highlight at least one of those as we look at the charts. But kind of a down day for the benchmarks, down day for sectors, down day for breadth. This is just one day, but as we continue on in the month of October, the more days like this, the less it feels like a bull market and more it feels like a corrective move. We'll certainly keep an eye on that. Looking at the Magnificent Seven and Friends kind of split, some things working, some things not. Meta, encouraging that it's up about 2.2%. That's bouncing off of support as we've outlined in recent reviews of that chart. NVIDIA making new all-time highs this week, up another 1.8%. So the NVIDIA trade certainly alive and well here. Netflix up 1.4%. There's another nice improving chart bouncing off of support. On the downside, Apple down 1.6%, Alpha down 1.25%. Everything else kind of close to neutral today. I think that's it for the market recap. Let's continue on looking at the heat map. I do see some questions and some comments coming in on YouTube, on X. We're also live streaming on LinkedIn and on Facebook. Again, if you have questions, if you're tuning in live, please drop them as they pop into your head. We'll review those questions as we go. Take a question or two at the end. And of course, if you're watching the episode later on our YouTube channel, please use the comment section on our YouTube channel anytime. We monitor those every day to see if there are any great questions coming in. Maybe we'll highlight one in our mailbag episode tomorrow. Kind of a rough day here when we look at the heat map, right? So, I mean, first impressions more down than up, right? And so the things that were up today kind of jump out. So let's start there, right? Benchmarks were lower. A lot of sectors were down. So what actually managed to have a positive day? Well, in the technology sector, NVIDIA making a new all-time high today. Oracle not quite making a new all-time high, but sort of heading in that direction, bouncing off of support around 280, now getting back up toward around $300 a share. So that's encouraging. Otherwise, not a great day for technology, right? I mean, again, random names doing okay, but I mean, on average, you have a lot of things kind of in a bit of a pullback phase. Arista Networks. We actually wrote about Arista earlier today for CNBC Pro. So if you follow my work there, I did an article on Arista Networks, looking at a couple different techniques, including the Ichimoku cloud chart, which I don't throw around too often, but thought it was a great way to illustrate a trend following approach to a leading name continuing to go higher. So check that out over on CNBC Pro. Alphabet not having a great day, continued to pull back, ended the day right around 240, made a bit of a shorter, a lower high on the daily chart just in the month of October. I think I grabbed that chart to review here in a few moments. So those are the things that are kind of doing okay. Let's talk about the things that are not doing okay. And it's over here in industrials. Like charts like Raytheon are a potential issue, right? Raytheon is one of those defense names that's just been in a nice primary uptrend. And as we've tried to reiterate, charts in strong uptrends are good, right? That's a good thing. So I don't like getting nervous when charts are going up and making higher highs and higher lows. And to be clear, Raytheon is still doing that as of this moment. Problem is today puts us just below the 21-day exponential moving average. That's sort of my initial assessment of trend. If we break the 21-day EMA, then I have to review it, right? It's sort of like I might need to take control of the plane and start to make some, make some decisions, or at least just be ready for further breakdown, right? Sort of have a good exit strategy in mind. And so the danger to this market, these charts like Raytheon and others just trending higher, start to divert lower. And when that happens, the question is what starts to work, right? If these are no longer working, then what is it working? Is it defensive sectors? Is it other asset classes? Kind of what's working? We'll come back to some things that are working, but across the board and sort of that, aerospace defense, some of the shipping names, look at EXPD, Expeditors International of Washington, Inc., breaking below the 50-day moving average. So these are charts that overall have been in pretty decent uptrends, have been above moving average support. And again, not end of the world yet, but just starting to change here a bit. The energy sector still under quite a bit of pressure. I mean, a lot of those charts have not looked good and continue to not look good, but obviously feeling quite a bit of a weight here. Another area actually showing some strength, and I'm just all over the place today, so apologies for that, but that's what I'm doing. Some big box stores, right? Costco, still not a great chart, still making lower highs and lower lows, but I like the initial rally. You want to see if a higher low could happen on a chart like that. Pepsi is another one, finding support around 140, starting to bounce. That's good, but let's get more accumulation before we really start singing the praises of a name that's been struggling since mid August to where we're at today. Finally, as I continue the stream of consciousness around the heat map, home builders continuing to look kind of ugly here. Here's Pulte Home Builders, or Pulte Group, that is, ticker PHM. We broke the 21-day EMA. We've now broken the 50-day moving average. And over the last week, I mean, this thing's just been a pretty good free fall. This is a great reminder to not ignore very obvious candle patterns. This is a bearish engulfing pattern after the bounce here. We have a big up day, a big day, a big down day. It's actually not quite a bearish engulfing pattern. I stand corrected to call it a dark cloud cover because we didn't quite make it below the first day's open, but still an ominous sign telling us the next 1 to 3 bars should be lower, and definitely seeing that here as well. What concerns me on home builders, the RSI level of 40 not holding, right? So going into September, we highlighted home builders as a fantastic set of charts because they all look like this, right? Above moving averages all sloping higher. A lot of that has changed here. And so I think recognizing, again, it's technical analysis, and for me is not about finding the charts that are working, although I'm thrilled to be able to do that using the technical analysis toolkit. For me, I think the real value of technical analysis is helping you recognize when something's not working anymore. Just getting out of the way when a stock is no longer adding value in your portfolio. If you can just do that consistently, you're going to avoid the really painful losses, right? Because I was taught all large losses begin as small losses. If we can keep our losses small, then we're going to survive and thrive in the next market cycle. So again, sort of a mixed heat map. I sort of stream of consciousness went something working, something not working. And you can see there's plenty of both here today. I encourage you to dig deeper into some of those, but again, some challenging charts here and quite a bit of red, even though the benchmark's rolling down slightly. Sectors like industrials, materials really stand out as having some significant pullback. So friendly reminder to make sure your stops are updated. We'll continue on with the chart review in a moment. Want to take a moment to thank one of my long-term supporters of the channel, Seeking Alpha. Seeking Alpha is a platform that I use and have made great use of. A couple things I really appreciate on Seeking Alpha. They have this portfolio health tool where it actually looks at all the stocks in the portfolio that you'd upload or link to, and it'll show you where you may want to start to look for potential areas of concern. Great if you have a number of holdings and you're just trying to keep on top of them. It's sort of like a great initial warning system. I also like their scanning capabilities built around their quantitative model, which I've reviewed. I've interviewed the founder, the creator of their quant model, Steve Kress, on my podcast. Thoughtful analyst, a really knowledgeable quantitative strategist, and did a great job, I think, empowering individual investors with the type of quantitative tools that institutions I've worked at have taken advantage of for years. So it's access to a really good institutional quality quant model. Gives you good opportunities to just find areas of potential strength and what's showing similar characteristics to other leading stocks from previous market cycles. You can find more about Seeking Alpha at marketmisbehavior.com/seeking alpha, or just scan the QR code that you see on your screen. If you use my link, it gives you a little better deal on their premium membership and allows me to keep Market Misbehavior awesome. So please check it out when you have a moment. All right, let's continue looking at some charts. I'll take a question or two. We'll call it a Thursday afternoon here in early October. The S&P 500 continues to be in a primary uptrend. I have it on candle watch here. I have the chart of the S&P here in a moment. We'll see what that candle actually ended up as. It was very close to kind of a bearish two candle structure. We'll see if that actually played out. But for now, again, new all-time high today. We made a high opening above 6750 for the first time in history. That's not a bad thing. Never be too bearish on a day the S&P is literally making a new all-time high, which it is today. We were overbought earlier, really at the end of last week, going into this week. We're now coming out of that overbought region. Does that suggest there's a bit of a short-term pullback? Most likely, at the very least, some sort of tactical pullback. When you have signs of a tactical pullback, when we're seeing concerns with momentum and breadth, I love to think about a line in the sand, that level. And as long as we hold it on a pullback, I think things are fine. I think things are fine above S&P 6550. Anything above there, I would just treat more as noise than anything. I don't know if there's a lot of signal in that yet, because that can be the normal rhythm of the markets, right? Remember, even if the market is in a remarkable uptrend, as it has been from the first week in April, there have been pullbacks, right? I mean, not end of the world, lose your shirt pullbacks, but pullbacks that certainly make you stop for a moment and go, okay, hold on a second, what's going on? And that's normal, right? Within the strongest of bull markets, you'll have these little pullbacks, right? That is what makes the uptrend, these series of zigs and zags. So zags are going to happen. So you want to think about how deep would a zag be? How deep would a pullback be? to where you'd really have to start, sort of opening your eyes and say, okay, hold on, is this something more significant? Do I need to take action and start thinking more defensively? I think S&P 6550 is that level. That's the swing lows from mid and late September. That's the 50-day moving average right around that point. I think anything above there is still pretty much fine. So we didn't, kind of right there. I'd probably technically call this a dark cloud cover, because if I look at the measurement, it certainly violates it. This is a dark cloud cover candle. That is a 2-candle pattern. We have an up day, and then you have a down day. Day two's body, the real body, which is the open to close, we have a higher open. We close at least 50% of the way through bar one, but we don't get below the first day's open. That would be a bearish engulfing pattern. We didn't get there, so it's called a dark cloud cover candle pattern. That suggests the next 1 to 3 bars more likely lower than higher. The way the built-in stop to that 2-candle pattern would be today's high. So the SPY gets above 674. The S&P 500 getting above, 6750 would be today's kind of intraday high, a little bit above there. That break above today's high would sort of negate that bearish short-term candle pattern, but it's kind of telling me going into the weekend, expect some weakness Friday into the beginning of next week. So we'll see if that continues, but that's the reading. This week, as we've made once again another new all-time high, we once again have less and less S&P members getting back above their 50-day moving average. I've been a bit of a broken record about this since the end of June, but that is a clear divergence of the market going higher with weaker and weaker breadth conditions. The real warning comes when we get below 50%. You can see, like back here in October and November of 2024, we started to see kind of a similar divergence, lasted for a couple months, and then eventually we broke below 50%, which tells you, all right, something's starting to really shift around here. And we're really, almost just right at that level. We have pulled back to the 50% level at the end of July, end of September, but we've held it. If we would break below that going into next week, I would, for me, starting to see more and more signs that a tactical pullback makes a lot of sense right about here. In my personal portfolios, haven't really made any sort of aggressive changes. The only real changes of positioning I've made have been trimming positions like gold and Bitcoin that have just had such crazy runs that they've become a bigger bet than I want to make. I still think it's a strong bet. I'm not, unwinding it because I'm nervous. I'm unwinding or just, trimming it just to just bring it down to a reasonable percentage of a bet that I feel comfortable making. We start getting worse breadth indicators. We start to break down in price terms. That's where I would start making more significant changes. But at this point, still positioned more on the long side than anything. Weekly survey data, sentiment data usually comes out Wednesday into Thursday. So Thursday's show is a time where we like to review the AAII survey. That's a survey of individual investors. We'll start there. We'll next talk about the Name Exposure Index, which is a survey of money managers. Starting with the individual investors, a little more bullish this week. And this is, usually runs through Wednesday afternoon. But bulls increasing to around 46%, bulls decreasing slightly to around 36%, about a 10% gap. Bulls outnumbering bears for the third straight week here. Not to euphoric bullish levels. Anything above 50% is where I start to get concerned that we're a little too bullish. We're very, very close to that level. So that combined with some of the bearish breadth indicators, I don't know, not making me feel particularly comfortable about the sustainability of the current uptrend. But again, as a trend follower, the trend is fine. NABE Exposure Index, which is a weekly survey of money managers, ticking up from around 81% last week to around 85%. Honestly, this is a pretty much an average reading on this indicator, maybe slightly overweight equities, but not by much. A while back, I interviewed the current president of Name, Ryan Redfern. Sorry, Ryan, I blanked on your last name there. Ryan Redfern, who is the president of the National Association of Active Investment Managers. Check out that interview on my podcast. You can find that on my YouTube channel. You'll hear directly from Ryan how he and other Name members actually, vote in the survey, what it means to them, how he uses it. At this point, it's sort of a neutral reading. I don't think it's telling me to be too concerned at this particular moment. All right, I mentioned my recent interview with Simon Ree. That should be coming out here hopefully very soon in the next day or so on my latest episode of the Market Misbehavior podcast. One of the things we talked about was the concerns that would be raised given a stronger dollar environment, right? So gold has been able to rally, Bitcoin and other cryptocurrencies have been rallying. I mean, those are kind of currency debasement plays, right? It's sort of a play on the weaker dollar. So the dollar's losing value. So go to hard assets that are gaining in value in dollar terms. And that's a good way to sort of hedge against that, depreciating value of how much your dollar works. If you look at the month of October, the dollar has almost been going straight up, right? So we've continued to trend upwards. This is the dollar index, which is $USD on the stock charts platforms. On other platforms, it's often a ticker like DXY. But if each platform may have their different tickers. So just look for a dollar index or like a dollar spot. The dollar doesn't actually trade. It's not part of the currency markets. You basically have all these other currencies like the euro, the yen, the Swiss franc, British pound that are all denominated versus the dollar. And so a dollar index is basically a weighted version of all of those different cross rates. So it kind of gives you a theoretical dollar value. And ETFs like the UUP are based off of that dollar index. So dollars strengthening versus other currencies. And that's starting to coincide with, you'd expect if that starts to really accelerate, that would be, more likely scenario would be gold rolling over and Bitcoin maybe rolling over. Not necessarily, it's no guarantee, but given the fact that gold has rallied so much with the weaker dollar environment, a stronger dollar from here all of a sudden starts to feel very, very different. So for today, gold also having a bearish engulfing pattern, higher open, lower close. That's on the gold spot that I'm seeing here, the gold future. Suggests the next 1 to 3 bars lower. This is after closing above $4,000 an ounce yesterday, and today kind of giving that back and closing back below $4,000 an ounce. Keep an eye on that one. I certainly will as well, with a pretty decent gold position. All right. Other things that are starting to change. And again, I'm starting to see this kind of October pullback narrative start to become more and more clear. Offense over defense, starting to favor defense in the month of October, right? Going into the end of September, the equal-weighted consumer discretionary sector performing better than the equal-weighted consumer staples sector. Now in October, we're seeing that ratio turn lower. The cap-weighted version also turning lower. Why is this a great measure of risk on versus risk off? Consumer discretionary, that's things you want. You don't necessarily need new clothes, a great trip, new whatever, a new watch, new discretionary purchase. You don't need it, but you want it. If you have the money available, if you're feeling all happy about yourself and you've got the money to burn, you can spend it on something as a treat, right? Consumer staples, you're pretty much consistently going to spend on shelter, on housing, on food, on beverages, alcohol, tobacco, cleaning products. You don't usually downgrade. I would say you don't downgrade your toilet paper when times are tight. You kind of have the Charmin that you always get. You just kind of do it. These are things that are fairly, immune to economic changes because you kind of have your level of spend. These are the things you need to just survive in whatever, cost of living structure that you have in your personal life. So you have something that is variable based on consumer confidence and available funds, and you have something that's very stable. So by looking at this ratio, we can see if the market is anticipating that investors or consumers are going to be more, spending on things you want or more staying defensive and on things you need. It has been favoring things you want since mid-April, both of these ratios. But now in the month of October, we're actually seeing a rotation lower. It's still not enough to say, this is the end of the world, because we've had pullbacks in the ratio off of the April low before. But this is definitely starting to look more and more like a change that we need to be aware of. Did you know in the last 1 month, the S&P is up 3.5%? How many sectors have outperformed the S&P over the last 1 month? Only 3. And here they are. Utilities up 9.6% over the last month. Technology up 9%. Healthcare up 4.5%. The S&P is up 3.5%. The rest of the 8 remaining S&P 500 sectors have all underperformed the S&P in the last month. So the number of ways that you can outperform the benchmark in the last month, very limited. And it's either technology or arguably the powering of technology, which is the utility sector. So tech and the utilities providing all the energy for all this cool AI stuff, or healthcare, where we're seeing biotech do well. We're seeing random names like Johnson and Johnson, hanging in there pretty well. Some pharma names doing okay, but that's about it. So the leadership in terms of outperformance sector-wise has been fairly limited. Something to keep in mind if you've been struggling a little bit in the last month. It's because a lot of sectors have been struggling on a relative basis. All right. So what's looking good? NVIDIA is getting very close to a $5 trillion market cap, which is pretty crazy, ridiculous. When you think about the idea that one company can have $5 trillion in market cap, and NVIDIA is very close to doing it. The ecosystem built around AI and NVIDIA, kind of in the center of all of it, just continues to, I think, redefine what it means to have a monopoly in a particular theme. But NVIDIA, for now, being treated with further new all-time highs. NVIDIA traded up just slightly above 195 today, closed around 192.50, but that's a new high. And after this pullback, breaking below the 50-day moving average in early September, now back to higher highs, higher lows, breaking above the August peak and continuing to accelerate higher. Strong chart getting stronger. I'm a fan of following trends like that until the chart tells me otherwise. Alphabet, also an AI play, also a cloud play, arguably very much part of this as well, with about a $3 trillion market cap, not making new highs in October. To the contrary, actually making a bit of a lower high earlier this week, and starting to break below the 21-day EMA today. Most recent swing low is here at the end of September, just slightly below today's low. We break that. 50-day moving average is right around 225. That would be an initial downside target, I think, on the tactical time frame. Watch this name. This is a big name in the XLC. This is a big name in the NASDAQ 100 and certainly in the S&P. And if Alphabet's not working, certainly not going to help the S&P and the NASDAQ as indexes make new highs. I mentioned the pullback in some of the industrial names today in particular. We've seen a lot of red in the XLI names on the heat map. Raytheon, ticker RTX, is one of those pulling back today, down about 3.8%, undercutting the 21-day EMA today. That's happened a couple times here recently, but the 50-day moving average has held. Most recently on a test right around Labor Day, right early September. That's what led to the most recent new high, pushing just above 170. So I want to see if the 50-day moving average can hold. If not, if the 50-day fails, if the RSI breaks below 40, that's where I think, for me, that's where I would start, getting very, very defensive on a chart like this. Look what happened the last time we tested the 50-day. We closed below it for one day, but the next day we went right back above. So it's sort of a whipsaw there. The RSI hit 40 and didn't go below. So that really is kind of a classic pullback within a longer term uptrend. That's a good setup. If, however, we break the 50-day and follow through to the downside, if the RSI breaks 40, that's what would tell you this is something different. For me, if I held RTX, which I don't right now, but if I did, that's where I would start getting more, certainly thinking more defensively. So what else is working besides NVIDIA? Albemarle. I was sending this out to my Market Misbehavior Premium members earlier today on our Market Misbehavior member community. We're talking about ALB, which is in the specialty chemicals group in the materials sector, making a new 3-month high. I often scan for stocks making new 3-month highs just to make sure that I'm aware of the names that are starting to work, particularly those that were consolidating and are starting to break out. The chart of ALB, really a consolidation, here, finding resistance in mid-July around 80, got up to around 85 here in August and September, but saw further and further pullbacks. The 61.8% retracement of that December 24 to April 25 low comes in right around 87.70. We had a failed attempt at the end of September, but about a week ago, finally resolved to the upside. This week, continuing to gap higher and push above the RSI is above 60, which tells us we're kind of a confirmed uptrend. Strong chart getting stronger, breaking above resistance, further upside, I would say, until proven otherwise. All right. Shall we take a question or two? I saw some questions as we went. I didn't have a good read on a lot of these, so let's take a look here. Elim, thanks so much for watching on YouTube. Is BE displaying an RSI divergence? I'm looking at the period from Monday, September 22nd to today. Let's bring that up. Not sure how to interpret RSI divergence Thanks for the quality update. Happy to help. I'm glad you enjoy it. It's a pleasure to do the show, and I appreciate you joining. So the question is this a bearish divergence? So the answer is, kind of. I would say kind of, right? Is it a divergence in the fact that prices are going higher and momentum is going lower? And that's really what a bearish momentum divergence represents, right? Higher highs in price, lower peaks in momentum. So the idea is, in a healthy bull market phase, we move higher on stronger momentum. So the RSI pushing above 80 each of these times just tells you, yeah, we're in a nice, consistent uptrend, strong momentum. That's good, right? That's what we want. What the warning sign, or what often happens at the end of an extended bullish run, is we keep making new highs, but on weaker momentum. And it's sort of like, the car running out of gas, right? It's the train running out of steam, whatever you want to have, whatever analogy makes sense to you, where we're going higher, but the momentum is weakening. And that often happens toward the end of the move, when the pace of the advance starts to slow and we start to get some down days in there that causes the RSI formula to show, show negative readings. For me, I would say the classic divergence would be where the first peak is overbought and the second one is not overbought. So the RSI is above 70 on the first peak, but it's below 70 on the second peak. That didn't really happen here. We're still overbought, which still means like the momentum is pretty fair. But is it technically a divergence? Yeah. Is it the perfect one that I would write a book about? I would not. Does it technically check most of the boxes? It probably does. So what do you do in this environment? So for me, what you have to remember is parts of the technical analysis toolkit are considered leading indicators. These are designed to help us anticipate something coming soon. A lot of the other parts of the technical toolkit are lagging indicators, not trying to predict something, but trying to confirm something. And I found that having a little of both in your repertoire helps quite a bit, because you have some warning signs when things are getting close. You have some confirmation if things are actually getting bad. Divergences are one of those leading indicators. Doesn't guarantee a top. It just tells me if I have 10 stocks and 3 of them are showing a bearish divergence, those are the 3 I'm probably going to be watching a little more closely and looking for a potential breakdown. So at this point, I would say if you own BE, and I do not, but if you own this industrial stock, what would you be looking for? Looking for breakdowns, right? Looking for signs that this divergence is now manifesting into actual deterioration, actual price deterioration. So what would we see that would tell us this uptrend is no longer in play? The 21-day EMA, this is exactly why I have this sort of indicator on my chart. The chandelier exit system is a kind of similar approach of using a trend following device, a trailing stop. And if we break that level, that for me would tell me at least take an initial move of some sort. Maybe take part off the table, right? You don't have to sell all of it. Just like you don't have to buy all of a position when something looks interesting. Take a little bit off, right? Add a little bit when things get a little bit better. So that's what the bearish divergence is. Again, it's not a perfect one, but I think it does, sort of satisfy that requirement of higher highs on weaker momentum. Now I would put it on a short list, looking for potential breakdowns. What else can we say to do? Rustin, thanks for a lot of questions here recently. Possible cup and handle on home builders could be good through 2026. Tell you, I am not a big fan of projecting anything through the end of 2026. I can barely forecast the next week in terms of things in my own life, I would say. So forecasting that far ahead, I think is, you can think about it. You can talk about it. It's good water cooler discussion. Would I bet that? I'm sorry, that's not home builders. I said home builders and I meant this one. ITB is what I meant, and not IBB. You said, is this a big cup and handle pattern? No. I'm wondering if there's a particular one that looks like a cup and handle. I'm looking at that one. XHB is the other big home builder ETF. No, and it depends on what, I don't know exactly what you're looking at, but like a cup and handle pattern, maybe you're thinking like this. So no, I would say not really. A cup and handle pattern would look like this. And I'm just going to butcher this chart for you for a moment and show you what a cup and handle would look like. What you have to remember is that technical analysis, particularly chart patterns, there's like the ideal versions, and then there's what actually happens in real life, right? So this would be like an idealized cup and handle pattern, right? We have a level of resistance. We have a big uptrend. We have this resistance. We have this big rounded bottoming pattern. We retest the previous high. And this is what I would say for now. We're not quite doing it. I mean, maybe some would say this is still an okay cup and handle, maybe. And then you have the handle. And the problem is the handle's looking less like a handle the further we go here, right? It was looking like was looking very, very good. If the price continues up and kind of retest that previous high, that would be a cup and handle pattern, right? So you have the big rounded bottom, that's the cup. You have the little handle, think like this is your cup of coffee. You break above the rim of the cup and the handle, that's the big buy signal. This is a pattern really pioneered by William O'Neill, founder of Investors Business Daily. Classic, breakout pattern for growth stocks. But I would say every day that home builders like XHB and ITB, which are the two big home builder ETFs, this is looking less and less like that idealized version. And at some point you have to say, that's not a handle anymore. All of a sudden that's a breakdown. That's something different. So, again, there's the ideal version and there's what actually happens. Is this a cup and handle? I mean, maybe, but we'd have to have a pretty significant improvement in the very near future on these ETFs. Otherwise, it looks like a cup and broken handle, which is not the type of chart I would personally be investing in. Folks, that'll do it. Thank you so much. Those of you tuning in live, having a great conversation, sharing some questions. I appreciate it. Those of you watching the episode later on our YouTube channel, please take a moment, share a question in the comments section. We will hand select some of those questions, answer them in our all mailbag episode tomorrow on Friday, October 10th. Don't forget to join me at the Orlando Money Show coming up next week, October 16th through 18th in Orlando. You can find more information there at marketmisbehavior.com/money show. Have a great evening. Enjoy your Thursday. We'll be back with you tomorrow. In the meantime, remember, it's always a good time to own good charts. Take care, folks.